The soft landing was just canceled. Hey, everybody, you're watching Bull Boom Bear Bust, back with another dose of economic reality. The economy continues to chug along on borrowed money, aka debt, and that's only possible with a currency that's allowed to be created at the click of a mouse out of thin air. And how long will this last? Well, this could last very long, but even with this type of currency, we're still seeing deflation in some areas. And that should be a big warning signal that we're seeing prices fall down, even though banks are being propped up right now with an emergency lending program. They're doing everything they can to keep this over indebted economy operational and to keep it functioning, right? So let's look at a couple areas where prices are really starting to correct, indicating that the consumers are tapped out. And if they're not tapped out, and this is for most people, they're close to being tapped out or on their way to being tapped out or maxed out with the ultra low savings levels, the ultra high debt levels, and high interest rates eating into household budgets like we've never seen in a very, very long time. Let's go ahead and start right here. Out of Mansion Global, U.S. rents drop for the third straight month as apartment construction booms. Now they're trying to blame this drop in rents on, oh, there's a bunch of new supply, there's a bunch of new apartments that are just built. Well, they've been building apartments for a long time, and the amount of apartments that we're seeing now completed is not that much higher than when we saw last year. So what it tells me is that they're having trouble finding people to pay these overinflated rents. Rising supply and vacancies are motivating landlords to lower asking rents, particularly in the South and in the West. This is what happens when people get in so much debt they're having trouble making their loans. Look at the student loan fiasco right now. Look at the car loan defaults, the highest that we've seen in many, many decades. And this is just the beginning. And here's just another symptom or another sign that things are falling apart. Now, you may not notice it because, again, with borrowed money, you may go to the restaurant. The restaurants are going to be packed, people waiting outside to get a meal. Looks like everyone's rich, but no, if you dig in to the information and if you see the real data, people are doing this on borrowed money and swiping credit cards for the most part. Now, nationally, rents are down 4.4% from their all-time high, which was the peak in August of 2022. And this is just the beginning. Remember, price declines on the way down are much more significant than price declines on the way up. Here's an example. Let's say you have a home that's selling for 200,000. The home value doubles. So 100% increase, it doubles from 200,000 to 400,000. So now the home's 400,000. Now the price drops only 50%, not 100% like it went up, but 50%. From 400,000, you're back to 200,000. You're back where you started, but the drop was only half as much as the increase. So it went up 100% to 400,000. Now it dropped 50%. Now you're back to 200,000, right? So these price declines, even though they don't seem like a lot, they're very, very significant because they're coming off very high numbers, overinflated numbers, and in fact, bubble numbers. Now, where else are we seeing significant price corrections? I'll give you a few seconds to take a guess. 3, 2, 1. Used cars. Wolf Street today. Used car wholesale prices have given up 53% of their crazy pandemic price spike. Now, this is the prices that are going at auctions. So you're not going to see this yet at the dealers. But in just a few short months, these dealers are going to get really desperate to start offloading some of these vehicles, especially the ones that they paid a lot for back at the end of last year, back in the summer of last year, and even in the fall of last year. They're sitting on the lots for longer. Let's take a look at a chart here. Again, this is out of Wolf Street, and this really paints the picture right here, doesn't it? We see the price spike. Back in 2014, we we're at about 12,000. Basically, it almost doubled up to 23,000 since then. Now that was almost 10 years ago, but now we're down from about 23,000 down to just over 18,000. So it's a pretty big price drop in only a couple years. And the peak in the summer of 2022, we call it right here. We said this was likely the peak. Prices will come down. It's pretty easy to see because prices had started inching down. They bounced back up, then they started coming back down. Higher rates, an over indebted consumer, just those two things alone, and the amounts of debt are things that should make it pretty obvious what was going to happen, right? So, what comes up must come down. Now, some people were afraid that we're going to see hyperinflation. That would have only been made possible by banks becoming completely nationalized. Luckily, that didn't happen. It has happened in other countries where we did see hyperinflation. Luckily, the United States, even though we have a lot of flaws, we didn't get quite that crazy on the banking system here. Doesn't mean that it's not going to happen in the future, though. But for now, continue to expect deflation in rents and also car prices. Folks, this is why we have the easy money bankers out there already talking about rate cuts in 2024. They see what's happening. They're not looking at how many people are lined up at the restaurant paying for dinner on a credit card. They're looking at the levels of debt. They're looking behind the scenes and they're seeing what's really happening. The reason I say that is because one of the biggest things I see down in comments is the economy looks great. All these people are at the restaurant that I went to. Everybody's got money. Everybody's rich. Wrong. Everybody has debt. And how do they have debt and the availability to borrow more debt and to buy things that they don't have money saved up for? Because the banks are being basically propped up right now with an emergency funding program. I can't stress that enough. We just surpassed this emergency funding program with the banks has just surpassed the total of all the bailouts that we saw in the 2007 2008 financial crisis. Going into 2009 too, they had packages, rescue packages, bailouts, TARP program, etc. happening. We've surpassed that, but yet hardly anyone knows about it because they're not calling it a bailout. They've changed the name for it. The news is really not talking about it that much. The business news, I rarely see it mentioned. Even online in my searching for all the news and the data that I do to get information for these videos, I rarely see that reported. It's something that's really being covered up right now. And I think that's why a lot of people are kind of scratching their heads saying, wow, look at all this debt. Look at these assets that people paid way too much for. Now they're underwater in their cars. Rents are dropping now. So people that bought investment homes, they're having a much more difficult time renting the homes out for what they paid for it or to rent the homes out for enough to cover their costs. And a lot of these people took out big mortgages hoping to rent the home out for top dollar. And then when the rents drop, then all of a sudden they're having trouble meeting their obligation. This is how it starts. And this is when you start seeing more inventory coming online. So, how are we looking in the car market? Or rather, how are we looking in the housing market? We just talked about the car market. How are we looking in the housing market? Is inventory starting to tick up? Well, let's take a look. The answer is yes. Let's go ahead and take a look at a chart here. This is a 1-year chart of inventory, and we see that we're up year over year. We have an increase in inventory. November 2022, just under 750,000. Last November, November 2023, 754,000. We're starting to see inventory rise now, and I think the next stop is we're going to surpass what we saw in 2020, and that's when the correction really begins. So unless they come out with some sort of massive rescue package like we saw in 2020, where they cancel the foreclosures, where they do unprecedented actions, we're going to see a big correction in the housing market. Now, I don't think it's going to be a crash. I don't think they want this to crash. In fact, I know they don't want this to crash. What happens in November of this year, everybody knows, of course, that's the worst time for the economy to crash for the ones in power right now. So I think they're going to do everything possible to keep this propped up, including extending the emergency bank rescue program that is scheduled to end in March. It was supposed to be a 1-year program that started in March of last year. We talked about that a lot in our previous video, so see that previous report to find out more about that rescue program. So this is what's happening, folks. Even with the emergency bank rescues, we're still seeing prices come down in some areas. We're seeing inventory rise in the housing market. So what does that tell you? That tells you that there's some really bad things happening right now, or good, depending on your perspective. If you're a buyer waiting on the sidelines, you have cash, you're waiting for costs of some of these things to come down, um, maybe great news to you, right? So this is not bad news. This is actually good news, especially if you have cash and you've been patiently waiting in the shadows for prices to come back to somewhat normalcy. But then again, what's normal? Seems like the world will never get back to normal. What's normal? Who knows? But anyways, hope you guys like this report. Please let me know what you think down in comments. The soft landing has been canceled as far as I can see. Please give us a like, subscribe, and we'll come back for more news and updates on this channel. Talk to you very soon now. Bye.